This video is meant for educational purpose and not stock recommendation. Today, we are going to explore Big Lots. So, what is Big Lots? Big Lots is a unique, non-traditional, discount retailer operating more than 1,400 stores in 47 states in America. They carry an assortment of products in categories such as food, consumables, furniture, and home decor, and electronics, and accessories. Big Lots is a publicly traded company listed on the New York Stock Exchange with annual revenues exceeding $5 billion. Here, you can see where they are located in United States. This is the number of stores for 3 years, 2018, 2019 and 2020. The stores are mainly located in Alabama, California, Florida, Indiana, Kentucky, Michigan, New York, North Carolina, Ohio, Texas etc. As you can see, the number of stores stay consistently for 3 years, around 1,400 stores. There are 5 distribution centers that are nearly 9 million square feet and use highly automated systems to receive, prepare, load, and ship merchandise. Next, we will look at the financial performance of the companies. We will look at financial ratios and you can see the earnings patterns of the company. This is gross margin. You can see the gross margin is upward. This means, the gross margin is higher over the years. This is operating margin. The overall trend is upward. This means operating margin increase over the years. Net income also increase over the years. Earnings per share also increase over the years. Next is operating cash flow. The overall trend is upward trend. For free cash flow, there is a dip in year 2019 but it bounced back quickly. For net margin, the trend is upward trend. For return on assets, it increases over the time. Return on equity also increase over the time. For debt to equity, it increases over the time, which may not be good, because it means the company has higher debt. The company has higher debt in January 2020 and dropped slightly in January 2021. Let's see why there is increase of debt in January 2020. We can go to Big Lots website to check it out. Scroll down to bottom of website and click Investors. Then go to Annual Report. This is year 2020 Annual Report, which is for financial year ended January 30, 2021. As the increase of debt was in January 2020, we need to check out the 2019 Annual Report. The annual report is always very long, but we need to know what we want to look out for. Scroll down to Consolidated Balance Sheet. Look for liabilities of the balance sheet, and you can see, the biggest amount is the non-current operating lease liabilities, which is $1,035 million. We need to read notes to the accounts to understand why there is such high amount of non-current operating lease liabilities. Scroll down to look for the relevant notes. Here, this is the lease notes. It mentioned that our leased property consists of our retail stores, distribution centers in California, store security, and other office equipment. The amount is $1,035 million. The disclosure quoted this Accounting Standards Codification 840. Under this accounting standards, Big Lots has to recognize future minimum rental commitments for operating leases from year 2019 to year 2023, which will be $1,319 million. The lease was commenced in year 2019 and Big Lots assessed it to be leases under this accounting standards, therefore, debt increases because of this new lease's future rental commitment. We need to know who are the competitors of Big Lots, so that we can make decision whether we can invest in this company or not. In this website, we can know who are the competitors and see how Big Lots fare among competitors. The competitors of Big Lots are Walmart, Costco, Target, Dollar General, Dollar Tree, and Five Below. Here, you can make comparison of the financial performances for the companies. You can enter up to 5 stock symbols to make comparison. Let's make comparison between Big Lots and Costco, Walmart, Target, and Dollar General. Looking at the annual revenue, Big Lots has the lowest revenue, with $6.2 billion. Next is cash flow. Big Lots generates 11.39 per share of cash flow. The higher the cash flow, the better. Target generates the highest cash flow, 14.80 per share, followed by Dollar General, 13.23 per share. For price-to-book ratio, a lower price-to-book ratio could mean the stock is undervalued. Big Lots has the lowest price-to-book ratio compared with the other 4 competitors. For net income, as Big Lots revenue is the lowest among other 4 competitors, naturally, the net income is the lowest among the 4 competitors, with $629 million, compared to other competitors that the net income are in billions. Next, we look at earnings per share. The higher the earnings per share, the better it is. Big Lots earnings per share is 7.35. Dollar General is ranked as number 1 in earnings per share, followed by Target, Costco. Big Lots, in terms of earnings per share, is ranked as number 4. For net margin, it measures how much net income or profit is generated as a percentage of revenue. It is the ratio of net profits to revenues for a company or business segment. The higher the ratio, the better it is. Big Lots net margin is 10.56%, the highest among all 4 other competitors. Next is return to equity ratio. Target is ranked number 1, followed by Dollar General and Costco. Big Lots is ranked number 4. For return on assets, number 1 is Target, number 2 is Dollar General and number 3 is Big Lots. For debt to equity ratio, the lower the ratio, the better, because it means low debt. Big Lots has the lowest debt-to-equity ratio compared to other 4 competitors. Generally, in terms of financial performance, for a medium-sized supermarket, Big Lots fare very well. Hope that through this video, you will understand the business and financial performance of Big Lots. If you like my video, please remember to like and subscribe my channel.